The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning. You are listening to Money in the Morning with Mitch Goldberg. Thank you so much for tuning in. This is 103.9 FM, LI News Radio. The number is stunning. And the number of the day is 1969. And although you might be thinking, I am thinking of the Eagles song, Hotel California, one of my favorite tunes. We haven't had that spirit here since 1969. No, that is not it. What we have is the lowest unemployment rate since 1969. The non-farm payrolls, the big payrolls report, just came out a little while ago. So much to digest. I am beyond excited. I love days like this when big economic stats come out. I find it fascinating. I dissect it. I look into it. I view the world in terms of economics. And if you think about it, almost every single decision you have has to do with finance. I mean, if you think about it, the car you buy, right? Where you send your kids to school, your mortgage, even in a way, love, love, because it impacts what we spend on the people we love, how much we spend on them, what we do for them. And these are financial decisions. So everything has to do with finance. Money makes the world go round. People say money is the root of all evil. But my grandmother straightened me out. She said, not enough money is the root of all evil. My father also used to give me really cool expressions. He once said, you don't know someone until you do business with them. And he also said to me, there are days you earn your money and there are days that you make your money, and they're not always on the same day. And that's kind of like investing. You earn your money over the long term, investing in whatever you feel is a viable investment. We talk mostly about stocks, the stock market, but there are lots of things to invest in. But you earn your money over time. You don't make your money until you sell, until you use those assets, you convert those assets into cash to pay for your needs and wants in the future. Isn't that the whole point of investing? And your needs and futures, your future needs and wants, will become more expensive because of inflation. Even a little bit of inflation we've had the last last decade or so, with the exception of the last year. I'm talking, let's say the 10 years before 2022, things still went up in price. It was most obvious in healthcare and the cost of college, but things typically go up in price, not down in price. So we have, excuse me for my little cold. Hopefully we'll be over this by the weekend, for the weekend. You have to, the reason you invest is because you pay for your future needs and wants. But those things, as they get more expensive, you need to invest in something that will keep up with those price increases over time. Because if you put away $50,000 today, for example, I use this as like the wedding example. You put away $50,000 for your daughter's wedding, for example. And that wedding might be in 3 years, it might be in 5 years, it might be in 10 years. But in 3 to 5 and 10 years, it's going to be more money. That same $50,000 for a wedding is going to cost you $55,000 or $60,000. So you invest the money because you expect that money to grow at a rate or faster than the rate of that inflation. Now, obviously, if you need the money in a year or 2 or 3 years, you're probably not even going to have it invested. So that's the whole point of investing. It's not just to save money. If all we had to do is save money, the world would be easier. You save money. It doesn't go down in a down market because it's savings. You don't have to worry about earning a bigger return if we didn't have inflation. But we do So we have to worry about a bigger return, higher return than a savings account or other cash equivalents. But to do that, we have to accept more volatility. So therefore, your savings, which is converted into investments, goes up and down. Well, you know the story. But today, the numbers were absolutely gigantic. Today is Jobs Friday. We get this once a month. We typically get it the first Friday of the new month for the previous month's jobs. 517,000 jobs created in the month of January. This is substantially higher than the 200,000 or so jobs expected. Wages were up. Hours worked per week were up. And what we've been talking about all week here is that the numbers you're seeing just are not shouting lately recession. And other things are shouting recession, but if you look at the numbers, the non-farm payroll number, the ADP payroll figures, okay, the jobless claims, the JOLTS report, and the big layoffs that you're seeing that are happening in the tech world where, Alphabet and other big tech companies are announcing layoffs, it's still only a small portion of the labor force, and those layoffs are not, as of yet, spilling over into other sectors. Other sectors are hiring, including in manufacturing, certainly travel and leisure. So this is not indicative of recession. And I think, like I said, the last couple of days, when I say, like I said, I'm not trying to say, oh, I was right. No, I'm just saying this is what we've been talking about. Maybe you didn't hear the show the last couple of days, or we kind of have to start where we were to catch up to where we are now. Okay. What we've been talking about is that the stats are not indicating recession at the moment. In fact, there's evidence that while inflation has been coming down, the economy is piping along, even improving a little bit. The worry is maybe this will spark more inflation next month or next quarter, and then the Fed will still be in play. The Fed cut rates a quarter point on Wednesday, 2 days ago. The follow-up statement sent the market shooting higher, where Jerome Powell, chairman of the Fed, said in his post-meeting points, his presentation, he said, and his Q&A, that we see inflation moderating, but we're still going to keep inflation at this level for a long time, but moderating the rate hike. The point is, it's interpreted as that maybe the Fed has one or two more rate hikes, small rate hikes, quarter point hikes in its arsenal, and then it's going to leave rates alone. This number today makes you think that maybe we've got more than one or two quarter point hikes going forward. But the productivity numbers that came out yesterday, we get productivity numbers, surged. So it's really a conundrum. And what that's called is moderating inflation with strong labor. That's the textbook definition of a term that we call Goldilocks economy. It will take more time to see if we really have it. And whenever we've had a Goldilocks economy, this was particularly used in the 90s when we had low unemployment and a decent economy pretty much through the last 6 years of the decade. We used the word Goldilocks all the time. We questioned it all the time. But you look back, it was a persistent economic condition, a good condition. So those are the big things. It's a stunning revelation to see the unemployment rate come down this low and the jobs created this high. Now, these numbers are subject to revisions. That is very common. We get revisions, and I wouldn't be surprised to see some of these numbers revised a bit lower. How much lower? That remains to be seen. But we have to believe that the Fed is thinking we just need to get the unemployment rate up to get prices down, because nothing slows demand more than seeing a lot of people lose their job. And plus, you could think about or worry about you losing your job. So the Fed has more work to do. You're listening to Money in the Morning with Mitch Goldberg. You can catch me and reach out directly to me by checking out clientfirststrategy.com. I am on Instagram. It's at InstaMitchG. If you like 30-second, 1-minute snippets, real quick video clips of financial know-how, check me out on Instagram. Follow me there. And if you want to reach me, you could message me through Instagram, Client First Strategy on Facebook. Please follow. And certainly LinkedIn, Mitchell Goldberg, AIFAAMS, Mitchell Goldberg. LinkedIn is my jam, and that is a great place to connect with me as well. Thank you so much for listening. We've got more coming up in the second half of the show. You're listening to LI News Radio 103.9 FM, Money in the Morning with Mitch Goldberg. Stick around for the second half after this brief message. All right, we're back. I love to just jump in there and interrupt the music because I feel like we need every second that we could squeeze into the show. You're listening to Money in the Morning with Mitch Goldberg. I so greatly appreciate you taking the time to tune in wherever you are, driving, probably most of you, maybe listening in your office, in your kitchen, wherever I am coming through to you. I greatly appreciate it. We all do here at 103.9 FM, LI News Radio. You can reach me direct and catch more information about me at clientfirststrategy.com. We started the show a little bit different just because I had to jump into those stunning jobs numbers, and they were stunning. I mean, the front page of every business section this weekend is going to be about the jobs numbers. You're going to see commentary ad nauseum on them, seasonal factors to adjustments, and these numbers will be, I wouldn't be surprised if they were adjusted a good deal lower, but they are the latest number, and that's what, the street tends to focus on. The number I'm focusing on is 2033, 2043, and on 2053. I'm focusing on the long term. So it's nice to talk about this, but if we were to start the show the usual way, I would have said the Dow futures are down 228, which they are. S&P futures down 54. Nasdaq futures down almost 300. That's a little over 2%. Oil is up just a smidge, up 26 cents. West Texas Intermediate, but still around $76.16. And the yield on the 10-year Treasury back above 3.5%. The 10-year Treasury is very closely tied to mortgage rates. So if you want to get a gauge for the direction of mortgage rates, you need to get a gauge of the 10-year Treasury, which is very easy to find and follow. Mortgage rates yesterday, finally, and we spoke about this earlier. I know I did it again. We spoke about this earlier in the week that I said with rates coming down, I could see mortgage rates going back to a 5 handle. They did. They went under 6% yesterday. Right now, they're 5.99%. That doesn't mean that you're getting 5.99%. They could be different regionally. They could be different with different banks. It also depends on your credit score, things like that. However, this stops the downside momentum in mortgage rates for the moment. Anecdotally, I spoke to a realtor friend of mine, and she sells houses. I would say she sells a lot of houses, $750,000 and above. And she got 4 listings this week, getting ready for spring. So anecdotally, and I speak with other realtors as well, it looks like there's going to be a lot of inventory coming on over the next couple of weeks. The season starts in March, maybe even a little earlier. So people are getting ready for that. And the weather's been warmer. I mean, granted, today it's really cold. It's going to be ice cold this weekend. But just think, 5 weeks from Sunday, we start daylight savings time. And I see it warming up a little bit later in the week. So just bundle up, get through this weekend. Got some plans tonight. I'm going to see the Van Halen laser show at the Vanderbilt Planetarium tonight. I'm looking forward to that. And I get up really early every day, so hopefully I don't actually fall asleep, but we'll see. So let's move on, okay? The number of stocks making big moves. So the futures are down today, and it looks like we're going to have a down day in the market. What we spoke about yesterday was that, we've had a lot of upside. Facebook, which is doing really well with Reels, competing very well with TikTok. So Facebook did exceptionally well, exceptional quarter, really positively received that Mark Zuckerberg in his post-earnings announcement used the word efficiency over 20 times, efficiency over 20 times, and they really want to focus on financials. It sent the stock soaring. The stock became under-owned for a very large stock before that, so people bought it. It's off a little bit today. But what I said yesterday is, we've had a lot of upside, and after the close yesterday, we had earnings from Amazon, Alphabet, which is Google, Meta, no, I'm sorry, not Amazon, Apple, okay, Alphabet, the A's. And it was, the numbers were not blowouts like they were with Meta, that's Facebook. They were good, but, I said the market is up so much, I wonder if there's any gas left in the tank short term because we've already had such a strong rally, such a strong January, and that's what happened. It just, stocks were ripe for a fall, I think, no matter how good earnings were from Alphabet, Apple, and Amazon. So Amazon is off about 4%. Company's quarterly sales beat analyst estimates. Current quarter guidance came in a little bit light. Their cloud business, which is their cash cow, is doing okay, but is definitely slowing down a little bit. So their current quarter is not as good as we had hoped, so it was just a good excuse to sell the stock. Apple saw revenues come down a little bit. The stock is down about 2%. The company missed expectations for revenues and profits. This is a rare miss for them. Holiday sales fell 5% year over year, marking the company's first top-line decline since 2019. Alphabet, is off about 3 or 4% this morning. It keeps fluctuating. They missed analyst expectations as well. It still posted revenue of $76 billion, but it was a little bit light, and that's the problem. High expectations for a stock are okay, but better to have low expectations and the stock and the company beats the numbers, because expectations over the short term has more to do with stock market direction and individual stock direction than, the actual growth of the company and the fundamentals. By the way, you can't invest directly into an index, but you can invest in a security that tracks or mimics an index. Ford is off about 6.5%. Lousy quarter. They missed everywhere. Revenues were light. Earnings were light. Expenses are up. Not a lot of good news out of Ford, and they're just having trouble, they say, getting parts. They say we're getting there. We'll fix things. But Ford is, a chronic disappointer. I feel like every time they come out with numbers. Starbucks was light. They said the U.S. business did very well, but the spread of COVID in China impacted their business. I don't know. The stock is up an awful lot, so the stock was due for a pullback. So that's what's going on with them. Nordstrom had a pop. There's an activist investor, Ryan Cohen, built a sizable stake in the company. Whatever. I don't buy stocks based on activist investors getting into them. Sometimes they get into them for the right reasons. Sometimes they go. But some people find it exciting. I look for better reasons to own a stock, meaning I want real growth fundamentals or real value in a stock. That's just my preference. Sometimes activist investors just walk away and give up. Clorox is up a little bit after market trading. Good numbers, good forecasts, good everything all around. U.S. Treasury yields. The headline here is they are leaping. They're surging. They're up a little bit after coming down quite a bit. You're still getting 4.8% on a 6-month T-bill, 4.7% plus on a 1 year. So if you want to just move your cash to a CD, they're available in the bank. But if you want to go for a little bit more, you could buy a treasury directly from the U.S. Treasury. You could buy it in your brokerage account. There's lots of ways to skin that cat. So just a super interesting day. with numbers. Next week is going to be a busy week as well. But I want to emphasize, I love talking about this stuff. I think it's interesting, but ultimately it's knowledge, it's education so that you could create the right investment and financial plan for yourself and so that you could stick with it. Because when you understand the macroeconomic factors, the microeconomic factors, the earnings, how the economic statistics work, when you start to learn about this, it makes you realize that down markets aren't a thing to fear. It's part of the process. You know the expression, failure is not separate from success. Failure is part of success. Down markets are not separate from making money. Down markets are part of making money. The problem for most people is they run out of patience before they run out of time. You're listening to LI News Radio 103.9 FM. I'm Mitch Goldberg, Money in the Morning with Mitch. I can't wait to speak with you on Monday. Thanks so much.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.